Hello, everyone. I hope you're looking forward to the holiday season as much as I am, and your Halloween costume is ever so slightly embarrassing. If you don't have one, I'm confident you'll find that person, and hopefully they'll brighten up your day. Sometimes it's better to observe and point than to participate, though, so just maybe keep that in mind. In short, straight through the Fort Pitt Tunnel. Please let me know when and where you prefer your year-end conversations to occur. During our time, I'll show you what you own, why you own it, and how we're buying profitable companies at reasonable valuations versus buying the overall indices. We'll also focus on year-end taxes and how we've managed them in your account so far this year. Markets have been kind, with international showing continued strength and overall value. U.S. markets have pushed higher as valuations have become more expensive on an indexed basis. Chasing high multiple investments is not something we advise over the long term, and we invest on your behalf with this in mind. The government shutdown continues, but markets have shrugged this off. We see the shutdown as being a net non-event for markets and portfolios at this time. Though not a priority, I do want to make you aware that we are looking to increase our YouTube presence for your benefit. Emails will be read to you like this one, tutorials, how to read statements, go paperless, and others will also be added. And now for the long way, 376 inbound up and over Mount Washington to downtown. As we work towards the end of the year, I want to invite you to schedule a conversation with myself per our 3-conversation process. During this meeting, we'll go over performance and investment as always, but also focus on realized, unrealized gains and losses. Please provide me any outside account gains and losses so I can get a full picture and make adjustments where I can for your benefit. I'm happy to work with your accountant at any point in time. No secret that markets have been generous over the past few years. One notable pickup has been in international equities, which have been in the doldrums for an extended period of time. In the United States, we're back to levels of valuations that we saw on indices in 2021 as measured by the S&P 500, which trades at 30 times earnings. In contrast to the herd, which is investing at what I think are over-enthusiastic valuations in the U.S., I believe there is much asymmetric upside potential in pessimistic valuations, and it is this pessimism of profitable companies that we at TRDC aim to exploit as we work towards your financial goals. There are 2 potential outcomes, and the first is that these valuations in coming years will look more attractive as companies fulfill on earnings expectations. For example, the S&P 500 trades at a price-to-earnings level of 30 times earnings, and if earnings were to actually double over a period of time, by buying now, you would effectively own future earnings at 15 times earnings, which is much more palatable. The time frame for this is infinitely debatable, though. Similar math applies to forward expected earnings. The second scenario is that a lot of the hope and efficiencies proposed to be gained in growth projections do not come to fruition. Artificial intelligence and large language models are here to stay and show great promise, but the valuations are not something I'm willing to gamble on with my own investments, and as an extension, certainly not yours. I'd rather own companies that have more room for multiple expansion to work in the reverse, whereby a profitable company trading at 15 times earnings or free cash flow starts to trade at 30 times free cash flow. All else being equal, this would double the price of the holding without changes to the stock. The fear of buying a market and equities that have little room for multiple expansion is a concern of mine. During our conversation, again, I'll show you what you own, why you own it, and how we're buying profitable companies at reasonable valuations versus buying the overall indices. There will come a time when we buy the indices, but at this point in the cycle, I think the risk-reward is concerning in a negative way. A few comments from an investment philosophy perspective. Bottom line earnings are not how we invest at TRDC. Instead, we prefer and use free cash flow as a business owner would, or a bank giving a loan. The reason is that in simple terms, a business owner does and is incentivized to reduce their earnings towards zero to avoid taxes while increasing their free cash flow to either pay themselves in the form of dividends or salaries, or reinvest back into their own businesses in the form of growth and investment. This can distort more sound valuation. In context, if you buy a company that has price to free cash flow at 30 times, this means that everything else being equal and zero growth, that it would take 30 years to make your money back. This seems like a risky proposition to me and not overall overly attractive. Your core holdings are ETFs that focus on price to free cash flow, and individual stock purchases also take this approach. A few comments on how the S&P 500 benchmark can impact popular mutual funds. Many mutual funds hug these benchmarks for their survival and also at what I would consider asymmetric risk versus upside reward. Fund managers are incentivized and often limited to benchmark drift regardless of valuations. It's not their fault, but it does limit the investment opportunity set. This holds true for commoditized portfolio, where in contrast at TRDC, we can invest in more thematic areas of the market, whether that be within equities, fixed income, or alternatives. As always, thank you for being a friend and client of TRDC. Please let me know if there's something I can do better for you, and have a fantastic day. Thanks. Bye.